When an auditor tests a population of transactions by selecting a sample of representative items, the auditor deals with what's called sampling risk, which essentially means that the auditor reaches a conclusion based on the selected sample when that conclusion is not correct had the auditor looked at every single transaction in that population. The two types of sampling risk include the risk of incorrect acceptance and incorrect rejection. Incorrect acceptance is when the auditor concludes that no material misstatement exists when in fact there was a material misstatement somewhere in that population. Maybe the sample showed no misstatements, but there were plenty in the population that just didn't get randomly selected. Incorrect rejection is the risk that the auditor concludes a material misstatement exists when in actuality there's not a material misstatement. For example, the auditor tests 50 transactions out of a population of 1,000. The auditor found one misstatement that projects to be material if it's applied to the rest of the population. However, there's a chance that the auditor found the one and only misstatement out of the entire population, so the conclusion may not be accurate after the auditor projects it.